Hello, everyone. I think we are going to start. There might be a couple more people joining as I start with the introduction. We had some issues with the name tags, but I think everyone has their right name now. So welcome, everyone. Happy to see you on screen. I'm Caroline Metz. I'm Senior EU Policy Officer at ShareAction in the EU Policy team based in Brussels. And I'm very happy to welcome you today on this event on insurers and capital requirements and climate risks. So big topic to be covering today. ShareAction is an NGO based in London and in Brussels, which promotes a financial system that serves our planet and its people. We like to call ourselves a critical friend of the financial industry, but I think we could also add to this that we're a critical friend of policymakers, and I will let some speakers agree or disagree with that. We try to encourage policymakers to be as ambitious as possible in terms of sustainability measures, and also to make the best use possible of the tool at our disposal to shape and regulate the financial sector, which is financial legislation or financial regulation. So today, I'm delighted to welcome all of you. I can see 50 attendees so far, but I think we have more people joining as I speak. So it's really great to see the interest for such a specific topic. And I know it's right after lunch, and we might be kicking off with digestion. We might be a bit scared to talk about such a niche and daunting topic, but I think we're going to have a really interesting time reflecting on the importance of insurance legislation and especially capital requirements as the insurance industry, but also all of us are facing an increasingly visible climate crisis. I hope, and knowing who our speakers are, because I picked them, I'm pretty confident that we will manage to keep most of you awake for the next hour and 15 minutes, hour and a half maximum. Let me take this opportunity to also thank very much all of our speakers, our two keynote speakers, and our three panelists. It's really great that you've made the time to join us today and to enlighten all of us about this very important topic. So thank you very much. We will introduce all of the speakers as we go along. But before that, just a little bit of housekeeping for everyone. So first of all, the event is being recorded, so please do take that into account. Second, if your name doesn't appear, you can change that on clicking on the top right corner and clicking rename. There is no general chat or Q&A at this stage. But in the second part of this event, you will be able to ask your questions to the speakers in a Q&A box, and you can still message us co-hosts and panelists if you have any tech issues, any sound issue, anything like that. And finally, just a bit about the structure of the event. So in the first part, you're going to hear from our two keynote speakers, Elana Sulakshana, who is a campaigner, and MEP Henrike Hahn, who has made time to join us today. We're very lucky to have them to set the scene and the background for more in-depth discussion. So Sulakshana is going to talk to us about the role of insurers in the climate crisis and what campaigning looks like to hold insurers into account. And then MEP Henrike Hahn is going to tell us more about her insider perspective on the negotiations on Solvency II, the EU insurance regulation, that are very much ongoing at the moment in the European Parliament. Then we will move on to our panel discussion per se, which will be moderated by Johnston, the policy director at ShareAction. Thank you for joining us, Louis. At that point, you will see a Q&A box, and you'll be able to type your questions to the speakers. You'll also be able to upvote the questions that you like, so that the most popular questions are being asked to the speakers, and so that the event is most useful to all of you. So why this event and why today? 2023 is an important year for insurance legislation. As most of you will know, we're in the middle of reviewing Solvency II directive, so the EU framework governing insurers and reinsurers. The review started in September 2021 and will hopefully be finalized this year. At the same time, EIOPA, the EU supervisor for for insurers and pension funds is consulting right now on the prudential treatment of sustainability risks for insurers. That means that EIOPA has started its work to assess whether there is a need to change capital requirements for insurers in the EU. So it's an important work, and I'm sure Justin, Wray, and Gabrielle will be able to tell us more about the supervision and the regulation of insurers as well. At ShareAction, we've been advocating for an ambitious EU sustainable finance agenda. And in particular, we've been advocating for strong sustainability measures in Solvency II. As part of this, and along with other organizations such as Finance Watch, and there I think Julia is gonna be able to tell us more, we've been advocating and campaigning for higher capital requirements for fossil fuel assets, because we do consider that these assets are particularly risky. And of course, this is going to be what we talk about today. Before we go into the topic, just a quick recap on what capital requirements are. So this is your chance to get up to speed if you're not familiar, if you're still a bit unsure, or if you ended up on this webinar by mistake. So there are many ways, let's say, to understand capital requirements. Some people just give up because it looks complicated, it looks a bit dry. I would say to these people, it's important that we all understand what capital requirements are, because it's a crucial tool at our disposal. Some see capital requirements as a financial stability tool. So there you could imagine a safety cushion, something that's there to absorb shocks, absorb losses. So the higher the capital requirements, the bigger the cushion, the more you're able to absorb shocks, to absorb unexpected losses and still be okay. So from that perspective, it's a very important function of capital requirements to maintain financial stability. In addition to this view, some see capital requirements as an incentive or a deterrent. Why? Because capital is expensive. And here, please forgive me for really simplifying the issue, and I'm sure speakers are going to correct this and bring more nuance. But basically, capital requirements at first glance are expensive. So if you set low capital requirements for a particular type of investment, you're making this investment cheaper. If you set higher capital requirements for a category of investments, you're making these investments more expensive. So that means that the way you set capital requirements are going to encourage or not certain type of investments by insurers. And this is a really key important notion to understand if you want to understand the wider debate on capital requirements. And that brings me to the last view, which is that some people see higher capital requirements are, as always, detrimental and bad. And I would personally argue that this is also because it might be a cost for some people. So of course, it's not going to please everybody. As I said, this is a very simplified view of capital requirements. The debate is much more complex than that, but I will leave it to our speakers to bring all these nuances and make you understand the in and outs of capital requirements. For us at ShareAction, we consider that they're a very crucial tool, both to get insurers protected against unexpected losses and against climate-related risks, but also to protect all of us, people, planet, against climate change. Before we dive into that topic of capital requirements, it's important that we set the stage in which all of this is taking place, both in terms of what insurers are doing and what are the links with climate change, but also in terms of the legislative background. So this is where our two keynote speakers come in. First of all, we're going to hear from Elana Sulakshana from the Rainforest Action Network. So she's senior campaigner there. She's been working fighting fracking in the UK. She's been campaigning for a university to divest from fossil fuels. And now she's been campaigning, holding insurers into account. And we're going to hear from her very soon. Then we'll move on to our second keynote speaker, Henrike Hahn, who is MEP at the European Parliament for the Greens Group. And she's one of the shadow rapporteurs on the Solvency II directive, meaning that she's one of the key MEPs involved in the negotiations at the Parliament. Without further ado, I'm going to hand over to Sulakshana. Thank you so much for joining, especially from the East Coast of the US, where it's quite early in the morning. So very much appreciating that, and over to you.
Okay, great. Hello, everybody. Good morning, good afternoon. As Caroline shared, my name is Elana Sulakshana, and I'm a senior energy finance campaigner with Rainforest Action Network, where I work on the Insure Future campaign. It's an honor to be here today alongside all of these incredible speakers. So I'm going to share some slides here. Can folks see that okay? Great. So my presentation today is titled Risking Our World, How Insurers Fuel Climate Chaos. And I'll be focusing on the insurance industry's risky fossil fuel issue, which, as we'll discuss today, is a massive problem that regulators need to address. That being said, when most people think about the intersections of insurance and climate change, it's generally the impacts of climate change, right? The climate-fueled floods, wildfires, and hurricanes, given the role of insurers in protecting communities. However, in many parts of the world, from Florida to the UK, insurance is becoming more expensive and less available due to these climate impacts. This is kind of the background in which Insure Future emerged, but we are a global coalition that promotes a rapid shift of the insurance industry away from fossil fuels to accelerate the transition to a clean energy economy. So instead of focusing on the impact of climate change to the insurers, we look at how insurers are in fact contributing to climate change. So as many of you are very familiar with, the science is clear that limiting global warming to 1.5 degrees Celsius will significantly reduce the impacts of climate change, and by extension, reduce the massive disruption to the insurance industry that climate change poses. And in order to have a fighting chance of reaching 1.5, we have a Herculean task ahead of us to reduce production of the largest driver of carbon dioxide emissions, fossil fuels. According to the Intergovernmental Panel on Climate Change, we have to drastically cut production and consumption of coal, oil, and gas. So when your house is on fire, as the Earth literally is from California to Siberia, the last thing you want to do is pour additional fuel on it. And yet that remains the agenda of the fossil fuel industry. The International Energy Agency, or the IEA, has declared that to reach net zero emissions by 2050, there can be no new investment in fossil fuel supply projects, even though kind of governments and companies are not heeding that call. And that's where insurance comes in. You know, all actors need to work together to radically cut emissions to reach 1.5. And insurers have a unique and important role as risk managers for modern society, quietly shaping acceptable levels of risk. So there are a few levers here. The first is its underwriting or insurance policies. New fossil fuel projects cannot be built without insurance, and existing fossil fuel projects and companies require at least some third-party insurance to operate. Insurers are also massive investors in fossil fuels. Collectively, as the second largest group of institutional investors in the world, where insurers put their premiums shapes the global economy. And I think one important thing to note here is that while insurers are propping up the fossil fuel industry, fossil fuels are not crucial to the insurers themselves. There are plenty of other things to insure. So the figures in blue on the right detail some statistics around that. So to get more granular here, Insure Future has developed the following 6 demands, and I'll just call attention to the first 3. So we kind of are calling on the insurance industry to stop insuring new and expanded coal, oil, and gas projects, and to phase out, in line with a 1.5 degree credible pathway, insurance for and investments in coal, oil, and gas companies. We also look at stewardship activities, emissions reductions targets, and human rights frameworks in underwriting processes. And these demands have been echoed by political figures and thinkers globally. There's a quote from the UN Secretary General Antonio Guterres, calling on companies that have made net zero commitments to address their fossil fuel underwriting, and as well as investing. So how are we doing on these demands? This is the 2022 Ensuring Our Future scorecard, which found that we've made remarkable progress on coal. There are now 41 policies from insurers restricting underwriting support for the coal industry. And we're seeing the impacts of these policies. For example, here in the US, in North Dakota, Premiums for coal plants and mines have gone up about 20 to 100%. And the number of major insurers willing to cover this industry has dwindled to single digits. This demonstrates that these policies do have a tangible impact on the ability of fossil fuel companies to build new projects and are accelerating the closure of existing infrastructure by raising costs. So how are insurers addressing oil and gas? As this figure shows, there are 22 policies on tar sands oil, which is a particularly carbon-intensive form of oil. And there are 13 policies that address conventional oil and gas expansion in some form, the vast majority of which were adopted over the past year. Here's a chart of these policies over time. While there is kind of momentum building around oil and gas, I'll note that there are some major geographies missing here, including the US, Japan, China, and others. It's very European focused. And while kind of these policies are being put in place, there are also kind of campaigns being run around specific projects to really draw attention to insurers' involvement in egregious climate bombs and human rights violations. So here's an example of the East African Crude Oil Pipeline, or ECOP. 22 insurers, following campaigns and engagement, have rolled out this massive crude oil pipeline in Uganda and Tanzania, but these are largely one-off commitments, because for the most part, insurers do not have frameworks or policies that address midstream oil infrastructure like pipelines or projects with human rights violations. And by continuing to support these projects, insurers open themselves up to reputational risks from customers and activist groups and employees or potential employees that don't want to work with companies that are involved with such destructive projects. So I think the ECOP example makes clear kind of how underwriting fossil fuel expansion is risky. There's many other risks that we'll hear about today associated with it. But kind of in the face of the climate emergency, people are no longer saying, you know, it's okay for these companies to continue to underwrite fossil fuel expansion. So I wanted to kind of bring us back to that quote from Antonio Guterres and think about the Net Zero Insurance Alliance, which is a group of now 32 insurers that have made commitments to achieve net zero greenhouse gas emissions and they're underwriting both insurance and reinsurance portfolios by 2050, and by extension to halve emissions by 2030. In June, the UN's Race to Zero campaign mandated that members of net zero alliances phase down and out all unabated fossil fuels. Yet the NZIA has so far explicitly refused to comply with this UN requirement. And this is an issue because less than half of the NZIA members have policies restricting underwriting of conventional oil and gas expansion. And when it comes to commitments to phase out fossil fuel underwriting in line with 1.5 degrees Celsius, well, these are the companies that fit in this category. This isn't an error. The slide is blank here because there are zero. It is abundantly clear that there is a massive gap between words and action, and NZIA does not appear to be stepping into bold leadership to close that gap. And this is why we need insurance industry regulators to step in and safeguard the public good. There's, so many risks involved in kind of supporting the fossil fuel industry through underwriting and investing. Setting aside all of the risks that the fossil fuel industry itself holds, kind of insurers' involvement in this really opens it up to reputational risk, financial risk, litigation risk. As we see lawsuits on fossil fuel companies mounting, insurers may be held accountable through their policies to cover directors and officers. Their financial risks, both kind of from supporting these industries, and then also given the broader long-term macroeconomic effects of climate change and how we're already seeing that touch down in the insurance industry. So we'll be hearing more about these risks and the role of regulators in addressing them. And so to close, I'll just kind of highlight again, the insurance industry is not moving fast enough to voluntarily reduce its climate impact. Even kind of the leaders in Europe that have adopted oil and gas policies are nowhere near where they need to be. And so this has to be on the regulatory agenda for those that are supervising the insurance industry and broader financial sectors. And all policies at the regulatory level, at the company level, will be evaluated on how they address oil and gas expansion and human rights in the short term, and not just the kind of long-term emissions reductions targets that sound great, but don't have the action to follow through. Thank you.
Thank you so much for this great introduction to the unfortunately often detrimental role that insurers are still playing. And we'll swiftly move on to Henrike Hahn's keynote speech, because I know she has to go soon after that. Unfortunately, she cannot stay for the Q&A. But thank you so much, Henrike, for joining, making time in your busy agenda. You're one of the shadow rapporteurs for the Solvency II directive, and an MEP in the Greens group at the European Parliament. And it's great to have you to hear more about how these negotiations are going. So over to you, Henrike.
Thank you very much for the kind invitation, and to ShareAction, and to you, dear Caroline Metz, on this roundtable to have the chance to talk about climate risks and capital requirements. And it's a very important topic in these days. And thank you very much to Elana, Sulakshana, for your very important ideas on that and thoughts. So we all know insurance regulation and climate change is not only a timely topic because of the ongoing Solvency II review, but also because insurers play a critical role in the green transition, both as long-term investors and as underwriters of the risks that our economies are going to face in the years to come. So for those reasons, it's crucial that we manage to future-proof the European insurance sector by adequately reflecting sustainability risks in the prudential regulations. And in 2022 alone, losses from climate change related natural catastrophes covered by the insurance sector amounted to 132 billion euro, which is 57% above the 21st century average. So at the same time, insurers continue to invest in fossil fuels, and many have not committed to phasing out their underwriting of fossil fuel activities in line with an orderly transition. And in the long term, this increases the risk of stranded assets as investments and underwriting of fossil fuel assets become worthless the more the economy decarbonizes. So it is in our hand to minimize the impact of fossil fuels on our economy and on the stability of the financial system by encouraging insurers to seriously move towards a net zero economy. So what is to do? So how can we ensure that the insurance sector can play a part in securing and maintaining a livable planet for the future? So as most of you probably know, the prudential regulation for insurance companies in the EU is built on a three-pillar structure. So a pillar one that sets the so-called capital requirements, a pillar two that deals with risk management and governance, and a pillar three that is focused on transparency and reporting. Now, in order to holistically reflect sustainability risks, it is essential that such considerations are integrated into all three pillars of the prudential framework. Stricter risk management rules or enhanced supervisory measures for sustainability risk will not be sufficient to address the risks emanating from climate change or the destruction of the environment. So as regulation, we need to make sure that insurers will have sufficient capital to absorb any future losses stemming from sustainability risks. To that end, we will also have to make changes to the first pillar of Solvency II. Therefore, new investments in fossil fuels should by definition be treated as investments in the riskier asset class, as they are bound to become stranded assets. Furthermore, supervisors should be allowed to set additional capital charges if they believe that undertakings are not adequately reflecting sustainability risks in their own funds. So the practice of setting capital add-ons is already integrated in Solvency II, and there's no reason not to explicitly expand this to sustainability risks. Already today, we know that companies with high levels of carbon emissions are prone to significant transition risks. And if insurers fail to adequately reflect these risks in the calculation of their capital requirements, supervisors should be able to set capital add-ons. Furthermore, I'm looking forward to the excellent work that EIOPA is undertaking on the prudential treatment of sustainability risks. This is something we discussed, of course, during the negotiations. And I'm happy to have Justin Wray from the EIOPA with us today to discuss their work. And EIOPA's latest discussion paper highlights clearly that a dedicated treatment of sustainability risks is both feasible and sensible. So now it's our task as legislators to provide EIOPA with a strong mandate to develop a methodology for assessing sustainability risks that can subsequently be integrated into Solvency II. So an issue that is very close to my heart is a German Green politician, and that maybe has not received sufficient attention in EIOPA's work, is the risk stemming from biodiversity loss and the destruction of the environment. So both the fight against climate change and the protection of biodiversity are high on policymakers' agendas, at least that's what I hope for, and industries that are especially harmful to biodiversity and the environment will be associated with the significant transition risks if the international community lives up to its promises and the recent pledges made at COP15 in Montreal. So now I would like to turn to the risk management side of Solvency II. There are a number of tools that would help to integrate sustainability risks into insurers' risk management practice. Firstly, I appreciate that the Commission proposal already includes a requirement for insurers to run climate change scenario analysis to assess their exposure to climate change related risk under different scenarios. However, in order to conduct a more meaningful analysis, it would be useful to specify further the design of these scenarios and to also subject insurers with a lower risk profile to this requirement. So secondly, a crucial element will be to spell out specifically in Solvency II what kind of transition plans insurers have to put in place. And we already managed to include a disclosure requirement for transition plans into the corporate sustainability reporting directive. So now it's our task for the Solvency II file to ensure that there's a strong requirement for insurers to actually develop transition plans with clear and measurable targets that align their business model with the climate neutrality objective enshrined in the EU climate law. And the insurance sector is probably one of the most important industry to put such plans in place, as they're both investors and risk managers of our European economy. So the European Parliament agreed just last month in its position on the CRD review that banks are required to adopt transition plans. And in order to ensure a level playing field between banks and insurers, it only makes sense to put the same requirement into Solvency II. So as a third point, to ensure that insurers provide a meaningful contribution to the green transformation of our economy, we need to introduce the stewardship approach in Solvency II. Insurers should use their shareholder rights for incentivize and steer the companies in which they invest to align their activities with the objective of climate neutrality. And this should, of course, go hand in hand with a broader obligation for insurers to integrate sustainability risk in their risk management and investment policies. So we could set ESG-related performance criteria as part of the remuneration policy for insurers management. And that way, strategic decisions are not only taken in view of the short-term benefit of shareholders, but also with respect to their long-term impact on climate change. So furthermore, insurers should be required to assess the qualification, knowledge, and experience of their management in the field of sustainability to ensure that they hire personnel that is able to cope with the reality of climate change. And lastly, we should enhance the reporting and its disclosure requirements for insurers in relation to sustainability risks, the so-called Pillar 3 of the Solvency II directive. And this way, insurers and the management are more accountable to supervisors, other market participants, as well as the public at large when it comes to their commitments to fighting against climate change. And supervisors will also have a better idea of the type of risks that insurers are facing and what exactly they're doing about it. So in our amendments for the Solvency II review, we proposed a number of targeted changes to the Solvency and Financial Condition report and the main disclosure tool of the prudential framework to integrate sustainability risks. And I hope that this brief run down on the many important instruments and measures that we can put in place to integrate sustainability risks into Solvency II has given you some food for thought and sparked some discussions for the upcoming panel debate. And while there are obviously priority issues that should be taken on board as soon as possible, I believe all of these instruments are needed to adequately and holistically reflect sustainability considerations in Solvency II. So of course, the final outcome of the Solvency II review will also very much depend on the political majorities that we can form. And I'm glad that there's a broad majority in the European Parliament at this stage for including ambitious sustainability rules in Solvency II. And even though the rapporteur seems so far less convinced of the added value of sustainability considerations, I'm very optimistic that we can achieve an outcome that will truly improve insurance regulation in the European Union. And as a last point, I don't want to close without mentioning that civil society engagement on this topic is very crucial to achieve a good result at the political level. And I truly appreciate the work that ShareAction and the many other NGOs and citizens are doing in the fight for a greener and fairer financial system. And that's very, very important for us. And I can only urge you all to keep up the pressure on us politicians, on me as well, both here in Brussels and as well as in the member states, because only with your work we can achieve a result that is ambitious as possible. So thank you very much.
Thank you, Henrike, very much for this kind words, and we will do our best to keep up the pressure. And yeah, thank you to you and to Elana for great keynote speeches that I think are really putting us in the right position and just on time to start our panel discussion that will really zoom in more specifically on the complex topic of capital requirements, which I think now, after these two speeches, we really understand the need for and the relevance of. So thank you so much. Sulakshana, thank you, Henrike. I will let you go. And Sulakshana, I think you will remain available for the Q&A later. So I will hand over to Lewis, my colleague at ShareAction. He is policy director and will be moderating the second half of the event. So over to you, and a reminder that from a second onward, you'll be able to type your questions to the panelists into the Q&A box. So please do that. And over to you, Lewis.
Thank you very much, Caroline. And it's fantastic to have everybody with us here today. Thank you to our two keynote speakers just before. As Caroline has said, I'm Director of Policy at ShareAction, and I'm delighted to be moderating such an impressive panel with such a range of expertise, and particularly on such an important, albeit somewhat technical and perhaps misunderstood topic. As Caroline has said, we are inviting questions. We would really like to take as many questions as possible from the audience here, which we will share with our panelists a little later on. But please do put those questions in the Q&A box, and you have the facility to vote those questions up or down. And so on the basis of those upvotes, we'll be selecting the questions that are in there so we can hopefully cover what people are really wanting to hear. We'll just briefly introduce our speakers that we have with us here today. First of all, I'm joined by Gabrielle Siri, who is Head of Sustainable Finance and European Cooperation at the French Prudential Supervision and Resolution Authority. Gabrielle has a background in financial policy and has previously been at the Bank of France and also the General Secretariat of the Economics and Finance Ministry. I'm also joined by Julia Symon, who is Head of Research and Advocacy at Finance Watch and has an extensive background in the banking sector itself, was previously an internal audit manager for 2 global banks. And last but not least, I'm joined by Justin Wray, who is Deputy Head of the Policy Department at the European Insurance and Occupational Pensions Authority, And he has a background with other pensions regulators as well, including in the UK. So first of all, welcome to our panelists. Just based on the excellent opening keynote speeches that we had there, I wanted to open with a question about the perception of this issue, and also perhaps just drawing out a little more why capital requirements and regulation for insurers are so important to climate. As Sulakshana described, this is often seen as quite an obscure topic where insurance and climate change are associated. It's often on the basis of insuring against catastrophic events caused by climate change. What I'm interested in exploring and hearing from the panelists on is exactly why insurance regulation, including the Solvency II reforms as described by Henrike Hahn just now, is of vital importance to climate risks and to the fight against climate change, and really just establishing that direct link, and therefore why people should take an interest. And also maybe if you may want to expand on any of the other points that came out of the keynote speeches just now. So if I can first address that question to Julia, and then I'll open up to the other panelists as well. But Julia, over to you.
Thank you, Lewis, and good afternoon, everyone. I'm very happy to be part of the excellent panel on this very important topic, which we've devoted a lot of kind of time and effort and ideas in the recent few years. I guess it's a great question, especially for the people who probably do not think about prudential regulation as such every day. As Caroline said at the beginning, it might sound dry and not immediately relevant for the people, or not immediately evident to the people why they should take care. But indeed, the prudential regulation, including the capital requirements, is there to make sure that insurers can serve the important societal function, so that they continue insuring the people, the businesses, the many different activities which happen in our economy, and without which the economy would not properly function. So we would like the insurers to be there. We would like them to remain solvent, right? We would like to see our services, our payments, life insurance, be it, or insurance against flooding. We would like to see those payments coming once there is something happening, and once we reach a retirement age, for example. And for this, we need insurers to function well and to remain solvent. So this is where the capital requirements come into play, and the prudential regulation overall. They are precisely there to protect the policyholders' interests and also to protect the taxpayers' interests in case an insurers would go insolvent because of many losses. And as we see climate change unfolding and accelerating, I think we heard from Elana like where we are now in terms of our 1.5 path. We are seeing more and more even more extreme and frequent weather events happening. So there are more and more payouts that the insurers are facing, which puts a question of will they be able to continue doing so in the future, as the future is not really predictable at the moment, especially if the necessary mitigation measures are not happening. So this is why we should really think about where are we with the prudential regulation, and where we are is that at the moment, climate risk as such and all the different implications of it are not reflected in the prudential regulation. What we kind of, if we ask ourselves the question, why should they be, or like, why are we having this discussion? In essence, the prudential regulation as such is risk-based. So any other risk type that insurers are facing is included in there. And the idea is, of course, that these risks are appropriately taken into consideration, so that this big idea of like being financial stability and policyholder interest protection can be effectively fulfilled. So this is why now, with the more realization of which risks climate change poses to the economy and to the financial system, we come to the realization that we need to think of how they can be reflected in the prudential framework. And I think from we've just heard from Henrike Hahn of like many different proposals and many different components of the holistic approach to this, which are being on the table and being discussed. And this, as Finance Watch, we are very supportive of all of that, and we also take a very holistic view on the different prudential measures. And this is why I think it's really important to realize that all of these are important, and this is not only a technical, very kind of dry and boring issue of some kind of rules for financial institutions. This is really the issue which eventually comes back to the citizens and policyholders.
Excellent, thank you, Julie. I think that was a really, really interesting answer and a great explanation of why this is directly relevant. I wonder if I could direct the same question to, first of all, Johnston, from a regulator's perspective. Why are capital requirements and regulatory requirements for insurers just of such interest from a climate perspective?
Well, thank you, Lewis. I mean, I'm tragic enough to find them interesting anyway, but I think it's a good question as to why why others should likewise. I mean, in the end, it's your money. I mean, in the sense that it is your insurance premium. It is, particularly in the world of pensions, it is your pension fund. So you have a right to be interested in what those who are looking after your money are doing. So if you want to if you want your insurer or your pension fund to be more sustainable, you have the right to advocate for that, and sort of, where as appropriate, invest accordingly. Let me just say a couple of other things, if I may. I mean, I agree with very much of what Elana and Henrike said. I mean, I agree with what Elana said about the importance of insurers as both investors and underwriters. I mean, insurers and pension funds, for that matter, own quite a substantial portion of the EU economy, and therefore how they invest matters. And the unique role of insurers in the in sustainability is as society's risk underwriters, as Elana said. And so again, it does matter sort of the how they underwrite what they choose to do. I also agree with what Henrike said about this affecting all three pillars. I mean, when you look at Solvency II, it is not just a capital requirements issue, it is also a risk, a governance and risk management issue, and a disclosure issue. And I think it's important to understand that sustainability cuts across all of that. Now, so one other point is that capital requirements are important. I'll come on to that, but it is also vital to understand that they're not the only option. In other words, if as a society you want to reduce carbon emissions, maybe you should be thinking about carbon taxes or other instruments. In other words, that while thinking about capital requirements is important, it's also desirable that insurers and the capital that they are asked to hold is not asked to kind of bear the burden of all of society's desires on reducing carbon, that other instruments are available and are important and arguably more effective. Now, in terms of use of capital requirements to address climate risks, I mean, I'm a supervisor, so I'm sort of required to be boring. So I would actually put it more the other way around. It's not so much from a supervisory perspective, it's not so much about addressing climate risks as making sure that climate risks are addressed. And that's a sort of important but subtle distinction. In other words, from the perspective of ensuring that insurers are prudentially sound, the prudential framework needs to reflect the risks that they face. And climate is one of those risks, and it's important that that this is addressed properly in the prudential framework. Now, there's governance, risk management, and reporting and disclosure, and all of that. In relation to capital requirements, I mean, in EIOPA, we are looking at this, as I think Elana already said. We are doing this step by step because it's important. It's important that any consideration of capital requirements is done on a kind of basis of a proper methodology and evidence. And at the moment, we have a discussion paper on sort of how you might look at this, and we will kind of turn later to what does the evidence suggest. But the how you might do it is I hope kind of relatively clear that climate does pose a risk to the assets held by insurers, either because of physical risk, just to something being flooded or whatever, and of course that is relevant in relation to the underwriting, and because of transition risk to sort of stranded assets that have already been referred to. And what is important from EIOPA's perspective is that there's consideration of how you might look at this, and then to see what the evidence says. Because I mean, I think because the prudential framework in the EU seeks to be based on evidence, quite rightly, that in terms of sort of balance between shareholders, taxpayers, policyholders, it's important that the prudential framework reflects the evidence as best we can. And therefore, as the sort of next step, we will be considering carefully what is the evidence in relation to the different aspects of climate risk, and then we will proceed from there. There's a couple of other things that we have done already on climate risk. Maybe I'll save those for another intervention because I don't want to take too much time. Thank you, Lewis. Back to you.
Thank you, Justin. And I'm glad you mentioned there the current consultation that is open on the prudential treatment of sustainability risks, which is open until the 5th of March. I'll refer back to that again later, but I just encourage everybody listening to input to that. Gabrielle, I wondered if you could just give me your perspective, and then I'm going to move on to a couple more questions about the process in the EU at the moment. But over to you first, Gabrielle.
Sure, thank you. And thank you for inviting me to speak in this great panel. Well, basically, I was going to say pretty much the same as what Julia and Justin just said, but maybe I'm just going to insist on one aspect, which is important in terms of financial regulation and what we envisage in Solvency II review, is when we look at the effect of climate change, it means more frequent and more drastic climate events. And it means for insurers that the cost of damages that they will have to cover are increasing very rapidly. And so we deem that the costs of these damages could double for the insurance sector by 2050. So in terms of capital requirements, it means that they will need, the insurers, they will need sufficient capital to face this risk and be able to just be able to face these damages and carry on their mission for citizens and for businesses. And so one aspect, I guess, that we're going to touch upon a little bit later is the challenge right now in terms of financial regulation and financial supervision is that we cannot only rely on what we call historical data. So in order to try to anticipate what it's going to mean in terms of cost, etc., you cannot only look at what happened in the past, which is basically how financial regulation is built right now. But with climate change, you cannot know, it's going to increase, it's going to be more frequent, but you don't know to what extent. And so it means that we have to move from only an historical data perspective to a forward-looking approach. And that's one of the aspects that is broached by the Solvency II review, with this regular review of what we call natural catastrophe risk and the corresponding capital requirements. And so the supervisors led by EIOPA will, if the reform goes through, will have to regularly review whether all the types of risks are covered. For instance, floods, wood fires, are they sufficiently integrated and to a proper extent? And that's something that is going to have to be integrated in financial regulation a little bit more. And maybe one last aspect, just to insist on how important the role of insurers is in this context, is that we see, and especially in, well, not really in Europe, but in Southern America, or, well, it starts in Europe, but that insurers are moving away from insuring certain risks, just basically because it's too expensive, and that's and just because, well, they don't know if they're going to manage to insure certain climate risks. And if they do, sometimes the cost of premium is too high for citizens, is too high for businesses. And it means basically that, well, citizens and businesses are going to be faced with, well, just natural catastrophes that they're going to have to assume the costs for themselves. And that's definitely not a world we want to live in. So it's, there's a lot of questions related to that. Of course, the role of the state behind it. And but basically, we want insurers to have sufficient capital requirements and to just be able to remain solvent and carry on with their missions of insuring these risks, because, well, basically it's well, it's just a crucial mission for us all. Yeah.
Excellent. Thank you, Gabrielle. I really appreciate everyone's answers on that point. And I think just to build on that, Sulakshana, I think, gave a very good breakdown earlier on of the different dimensions of climate-related risks. So when we conceptualize this, we think about the physical risks posed by catastrophic climate-related events, but also the transition risks associated with stranded assets, and reputational risks, and linked to that, potentially litigation risks. I wondered if next up we can explore how everyone foresees that potentially affecting insurers in Europe, and then crucially what the role of higher capital requirements might be in tackling that, and whether higher capital requirements might deter insurers from underwriting new fossil fuel projects and investment. So I wondered, just to start with, if we could come to you, Johnston.
Sure. I think it's important to understand that the different aspects of climate risks are likely to hit different kind of insurance lines of business differently, and will hit in different sorts of insurers differently. So on the non-life side, I think the sort of climate is more likely to impact on the liability side, and perhaps physical risk is the greater problem. I mean, all the floods and other events that everyone has already been referring to. On the life side, although of course aspects of, say, mortality may be affected by climate risk, the issues may be more on the investments by life insurers, so more onto the asset side. In both cases, of course, there is the reputational risk, which has already been referred to, and you can see that there are different responses of insurers to that. Liability risk is also potentially an issue. As to your question, will higher capital requirements deter such investments? I mean, that is, from a supervisory perspective, that is not the purpose. I mean, the purpose of the capital requirements is to reflect the risk. So, they may or may not deter, but what is important from a supervisory perspective is that they reflect correctly reflect the risk. And actually, let me just pick up on one point that Gabrielle made, that whereas for most insurance risks, you get a good idea of what is the risk by looking at what has happened in the past. Of course, the nature of climate risk is different. And one of the things that we propose in our discussion paper is to have some sort of forward look as well. But still, the kind of principal way you would measure the risk is to look at what has happened in the past, but to also take kind of scenarios from reputable organizations and see whether what you might propose is consistent with those scenarios as well. Thank you.
Excellent, thank you, Justin. And I think you make a very good point about the need to consider both sides of the balance sheet in these questions. And obviously, in both instances, insurers are play a hugely important role. Julia, I wondered if you could expand on that and perhaps also touch on Gabrielle's point earlier about the nature of climate-related risks being quite unique in the sense that there's not a precedent perhaps in the same way in terms of a historical series, a data series to set us against. Over to you.
Thanks, Lewis. Indeed, I cannot agree more, and I think this is the very, very critical aspect which kind of comes also in the work that IOPA and also EBA on the banking side are doing. There is the realization, and I think like we all agree that we won't be able to grasp fully the climate-related risks, be it physical risks with the acceleration of climate change or transition risks with the assets trending which we have in front of us in case we agree that we keep the climate commitments and keep the transition. So all of that we won't be able to find in the past data because the climate change, like it's accelerating, has not happened in the past because we have not yet had the transition in the past. So searching for kind of past data and like the so-called risk differentials is probably not the most useful exercise in this case. At the same time, I would like to kind of stress out two very kind of important things, which I guess we always have to remember when we speak about all the different types of climate-related risks and how we approach that. So on the one hand, we have the notion of the numerous very complex effects which come about in the economy as climate change unfolds. Which means that just like kind of to draw a very, I don't want to say a doom scenario, but in a sense, if we have more and more climate-related events happening, it brings directly the physical damage to businesses, to regions. With it, we have, for example, unemployment, we have business interruptions. So we also have kind of cascading effects, which are quite complex. And I think as we follow the different scenario analysis and stress testing work, which are undoubtedly very useful and interesting to look into the nature of these risks, but all of these complexities are not yet being able to be reflected. So this is why we have to take this kind of forward-looking projections very seriously, because we do not want to go down the path of this very interconnected and complex disruptions in the economy. At the same time, we also have the climate science, which speaks about the tipping points, right? We all, I think in the meantime, everybody is familiar with the notion of a tipping point, which is a point in the climate risk materialization where the effects become very disruptive, very unpredictable, and most importantly, irreversible. So once we go beyond that kind of threshold, we won't be able to kind of to manage all these effects. And of course, then all the measurements and modeling that we have done will be useless because the disruptions be really of a major nature. So this is very important to think about forward-looking analysis and also timely and precautionary actions on this type of risk. And on the other hand, I think also like I completely also agree with Justin in terms of like evidence-based policymaking or evidence-based policies. So even if we do not have a very precise modeled or measured, let's say, climate risk quantification for every specific assets the insurers might hold or every specific kind of policy that they might underwrite, we do have climate data, which also Elana once again brought into our attention. We do have very clear understanding and even numbers of what has happened to certain industries, specifically fossil fuel consumptions, as we move alongside the net zero path or the climate change mitigation path. So if we take all the data and look what will be happening in the in the real economy because of that. For the fossil fuel industry, starting with this one, because this is where the evidence is most clear, we can already qualitatively say which assets might be of a higher risk, and where we already can define precautionary prudential measures. And of course, they will not be 100% correct in that sense, as probably the current measures are not either, because they are all calibrated based on the past data, which increasingly turns inadequate as we move more into the future and the climate change unfolds. So we do have sufficient data and evidence to start defining those actions. And I think the last point I would like to make here is that the risks that we are running in case the climate change risk is not mitigated, or the climate change is not mitigating, the risk of this like crossing the tipping points and like major economic disruptions is so much larger and will bring such high social costs that is probably, based on the impact analysis, it would be much more prudent also from the supervisory perspective, from the prudential perspective, to act today than to wait where we will be then beyond the point of no return.
Thank you, Julia. Gabrielle, I'm going to move to audience Q&A in a moment. Just a reminder to the audience, you can upvote some of the questions that have been coming in the Q&A box, but I just wondered if you wanted to come back on that first, Gabrielle.
Well, I think in terms of the supervisory perspective, it has been perfectly explained by Johnston. The question we ask ourselves as supervisors is whether the climate risks are sufficiently covered by the regulation, by capital requirements. So what is in question right now in the Solvency II review is to study the risk differential between high carbon assets, for instance, fossil fuels, and other types of assets, for instance, green assets. And we look at whether some are riskier than others, which would justify that that capital requirements are different. To put it in a simple way, but I think it has been perfectly explained at the very beginning of the session by Caroline. But if an investment is riskier for an insurer, then it makes sense that capital requirements are higher. And of course, it has an effect in terms of climate and the environment, meaning that if investments in fossil fuels become more expensive to insurers, they might divert and divest from these types of sectors, and it would have a positive effect from an environmental point of view. But again, so I'm going to speak as a supervisor. The question is whether it's riskier or not for the insurer, and if it is, then it can be adapted, and we have to try to know how much risky it is. But as Julia just said, it's very difficult to assess very, very precisely how much it's going to cost. And then the question, and let me just mention a paper by the French Institute for Climate Economics that tried to assess what the effect for the environment would be of such a measure on fossil fuel assets. So if you make these investments more costly or for the financial sector. So they think that if you target this scheme on a very specific types of asset like fossil fuel, and make it quite heavy. So if you make it way more costly for the financial sector, then the exit from this type of investment could be quite quick, actually. So they studied it for the banking sector. So let me specify this. That's the French paper. I could put the link in the chat later. But they think that in a time span of 2 years, the sector could that massively divest from these fossil fuel assets if this scheme or if it's designed in the right way. But again, it's a political question, and it's something that Henrike, Hahn and other politicians have to address. If the objective is that the sector moves away and divests from fossil fuels, then it has to be tackled by politicians. From a supervisory point of view, the question is always going to be, how risky is it to insurers? So what I'm trying to say is that, of course, the two perspectives are linked, but there is a difference of point of view, and let me conclude by encouraging you to respond to the public consultation put online by EIOPA, because I think that all these different perspectives need to live together, or need to be present in the public debate. But again, from a supervisory point of view, it's always going to be, is it riskier for insurers? How much? And then what kind of, basically that's it.
Thank you, Gabrielle. Excellent. And I just echo that encouragement for everyone to respond to the EIOPA consultation. I'm going to move to the audience Q&A now. Thank you very much. There's been some excellent questions coming in, and to get through as many as possible, I'll start with those who've been voted the highest, but also try and take maybe two or even three at a time. So our first question is really about the differences and parallels between banking and insurance legislation in the EU. When are banks' capital requirements up for review, and is there likely to be an interplay between the review for insurance and for banking? So I'd be interested to hear the panelists' views on that. And then a question here from David Clark on the role of supervisors' assessments of climate transition plans in setting capital requirements. So what is the relevance of transition plans when capital requirements are set? Justin, I wonder if you could start with those two questions.
Sure. Let me start by saying, of course, I work for EIOPA, so insurance and pensions. So I'm not a banking expert, but I mean, there are certainly things that I can say here. In terms of looking at banks' capital requirements, both ourselves and the European Banking Authority have the same potential mandate, which is to look at the prudential requirements. So, I mean, a lot of reference has been made. Thank you already to our consultation paper. This arises from proposed legislation in Solvency II that EIOPA does a report on the prudential requirements in relation to both green and brown investments. Now I say potential because of course Solvency II isn't finalized, so this legislation has to be agreed by the co-legislators, and then we have the kind of formal mandate to do our report. Anyway, I say that because EBA has the same mandate. So in terms of looking at banks' capital requirements in relation to sustainability, this is something which I know they are already looking at. I think it's important to understand where there are similarities and differences between banks and insurers. So I think as investors, I mean, there are some similarities. I mean, both are significant investors in the EU economy. The climate risk of a particular investment is, I would have thought, sort of pretty similar whether you're a bank or an insurer. So one can see that there could be sort of reasonable similarity of treatment there. On the other hand, only insurers underwrite. So in terms of the kind of capital requirements for underwriting, that is much more an insurance specific issue rather than for the banks. So, you know, I know EBA colleagues are looking at the prudential requirements, but you know, the overlap is much more in the area of investment, and sort of underwriting is more of an insurance specific thing. On the other hand, sort of those that banks loan to is a kind of banking specific thing. So that's something for them to consider. On the transition plans, I'm not sure there is any immediate connection. I mean, in the sense that the capital requirements apply to everyone. So here is an asset, or here is an underwriting activity. It poses a risk to the insurer of a loss in value, and they need to hold sufficient capital to protect against that loss in value on a 1 in 200 basis. And that sort of those capital requirements apply whether you have, whatever, whether you have a good transition plan or not. I would have thought the transition plan is more something for sort of what you might call individual supervision. So when a supervisor is looking at an individual insurer, of course, it will be interested in the quality of its transition plan, and it may make it may ask for changes by the insurer in light of that transition plan. But I'm not sure, sort of off the top of my head, as it were, that there is a direct connection with that and the capital requirements. Thank you.
Excellent, thank you, Justin. Next, we've got questions for the panel on the link with the current situation in the UK. So it's a question here from Mick McAteer. The UK government is pushing for a pretty serious weakening of Solvency II. We saw those announcements towards the end of 2022. Do the panelists have any concerns about the effect this might have on EU policymakers and the potential kind of interplay between regulatory change in the UK and in the EU? And I will start with Julia.
Thanks for the question. Indeed, we like in our work, we obviously look a little bit around as well what happens in the other jurisdictions. As we speak about the issue of climate change and climate related risks, there is no borders to that, obviously. I would say the kind of the relaxation of requirements both in the UK, which we see kind of coming, as well as in the EU, the famous capital release to finance the transition are equally concerning to us, because of course, if we speak about kind of reducing capital requirements for financing transition, we should ask ourselves the question, which kind of guarantees or which criteria do we have to make sure that that capital will indeed go into financing transitional or sustainable activities, and not just continuation of the business as usual and into the activities as it is now. At the same time, so of course, I think a lot of insurance companies, they have cross-border business, they are active in the EU as well as in the UK, so there are concerns with respect to what happens with the regulation, which is ongoing, as well as with the level playing field. However, we do not think that that should be a kind of a game changer or a deterrent for the European policymakers and then the supervisors to take actions which are appropriate to address the problem we are discussing today. We've seen that a lot of European insurers which are sitting here, they are globally active, right? So this is still a very important, they are still very important providers of the services. They are still a very important investors globally. So that shouldn't be a reason not to act. And as we also discussed, the prudential regulation is there in place to make sure insurers cover their risks and remain kind of solvent and be able to provide their services going forward. So that means that we should, of course, look at what we have in our economy here, which services are we expecting from our insurers in the European Union, and whichever measures are appropriate should be taken. So because the financial stability concerns, they remain, and really like what we do with the regulation in the European Union is really in the service of the citizens of the European Union. Unfortunately, maybe some other jurisdictions might not be able to think the same or not be able in the position to implement ambitious proposals at the moment. So this is still a good way to go. And I think the last point I would like to make, coming back to where I started, is that the climate-related risks and like the climate accelerating activities that insurers are implicated with, they have obviously no border. So it is important also to work cross jurisdictions and like work on the international level. We are increasingly also looking to what the International Association for Insurance Supervisors is doing, and which steps might be taken there to make sure that climate risk is reflected in the insurance core principles, and that there is more kind of a race to the top rather than race to the bottom in there.
Thank you, Julia. Thank you very much. And I wondered now just if we can address a couple of the other questions that have been put forward. So there's two in particular here that I think overlap slightly. One is about the discrepancy of resources between civil society and the financial industry, and what the panelists' views are on that, and what can be done to rebalance things and make sure that regulators are attuned to the needs of society as a whole. And again, just point towards the consultation, that the IOPA consultation, which is currently open, and encourage everyone to respond to that. And then the other question here is about how we can ensure the integration of environmental risk into the capital requirements framework will not put EU insurers into less competitive positions compared to non-EU insurers. So that's there's a slight parallel, I think, with the question that you just addressed there, Julia, on the different situation in the EU and UK. So I wonder if we start perhaps with Gabrielle, just to take on those questions, and then I'll open to the other panelists, and then we'll soon be drawing to a close. But over to you, Gabrielle.
Yeah. Maybe more specifically on the second question, the question of competitivity, that's actually not the way we see it, because if we manage in the EU to have a regulation that appropriately covers the risks for insurers, it's of course also in the benefit of insurers. And let me here insist on one aspect that we haven't really discussed yet, but is very crucial when we discuss this topic. And there's also a link with what is similar in banking and insurance supervision. We have this very specific category of risks, which is called transition risks. Transition risks basically is the risk of loss of value of investment of insurers or banks, due to restrictive environmental measures, or to shift of consumer preferences. For instance, if let's say, I don't know, it's totally hypothetical, but if it begins to be forbidden to invest in fossil fuels tomorrow in the EU, the value of the investments related to this is gonna drop. And transition risks is this very category of risks that we deem that could be underestimated right now by the market. So if we manage as financial regulators, supervisors, to really appropriately apprehend this category of risk, it's going to be in the interest of everybody, including the insurers. And right now, so I'm going to quote two studies. The ACPR deems that 10% of the insurers' assets are concerned by these risks. And in an IOPA study called sensitivity analysis, it could be up to 25% of loss in the long run in fossil fuel assets. And we think that this could be underestimated right now by insurers. So by building an appropriate financial regulation, we actually also act in the interest of the insurers and the financial sector. So it's not something that I don't think that it has a negative impact on the long run on competitivity. And something else also is that the EU right now is actually in the forefront of financial regulation when it comes to considering climate risks. And so one sign of that is that the work we're doing at the EU level, be it in IOPA or as financial supervisors, is looked upon by in international fora. So for instance, the Sustainable Insurance Forum, for instance, the IIS. So that's kind of, well, soft power. It may not be the exact wording, but you see what I mean? It's something that it's very much looked at in other countries around the world, precisely because that's a crucial stake for everybody. So I think also that's a sign that it's not necessarily detrimental to the competitivity or to the financial sector of a specific country.
Excellent. Thank you, Gabrielle.
And I'm going to put a few links to papers I mentioned earlier in the chat.
That would be fantastic. Thank you very much. And just to also highlight to everybody that the link to the IOPA consultation has been put in the chat as well, so you can find that there. I wondered, we are running out of time. I mean, this is a discussion that could continue indefinitely all day, and we've only just scratched the surface. So I'm very grateful to everybody. Just very briefly, Elana, I wonder if I could bring you in on this question around the making sure that the voice of civil society organisations is heard in the debate, and perhaps drawing on some of your experience at the Rainforest Action Network, and then we'll draw proceedings to a close. But yeah, over to you.
Sure, thank you. And yeah, thank you for this fantastic panel. I've learned so much about kind of the regulatory framework in the EU and all the incredible work you all are doing. Yeah, I think, you know, Insurer Future, you know, aims to kind of engage across, you know, different social movements, organizations, impacted communities that are, you know, both in terms of, you know, impacts from fossil fuel infrastructure, but then also from climate disasters, and communities that are losing insurance coverage, or maybe, you know, pension holders, unions. And so, you know, we're recognizing that these risks cut across a number of different communities, trying to kind of engage across this really diverse group. And, you know, I think there's the piece on the direct pressure on companies, like I discussed, right? The kind of campaigning on the insurance companies and pushing them to improve their policies and practices, but then also that, you know, we need to be really paying attention to what is happening in the regulatory spaces, and then even these financial alliances and non-regulatory spaces, but places where kind of decisions are being made, and you know, financial institutions are coming together to kind of develop these you know, ways of governing around climate risk. So both you know, in terms of thinking through participating in these kind of public consultation processes is so important, as all of the panelists have said today. But I also think there's a really important role for civil society to kind of monitoring and tracking and intervening in the public sphere, kind of outside of these consultations as well, and kind of breaking down what's happening. And I think, you know, Justin put it nicely earlier, the ways in which individuals, you know, really do have a stake in how these risks are governed, be that because it's their pensions or their insurance policies. And so I think it's kind of on all of us, and, you know, everyone here watching, to figure out how to kind of translate this kind of complexity of the policy in ways that people can engage with.
Excellent. Thank you, Elana. And I think that's a good note on which to conclude the discussion. I've thoroughly enjoyed this event. I would just like to really extend my thanks to our keynote speakers, but also to our wonderful panelists for all of your insights. I've learned so much, and it's on such an important issue, and something that ShareAction is certainly very engaged on. I think just to, as Caroline explained earlier on, ShareAction is engaged in so many ways in trying to affect change in the financial sector, both through our research and our direct engagement with financial institutions and companies, but also through trying to shape promote the highest standards in legislation and regulation as well. And I think that the question of capital requirements for insurers is an illustration of the need for ambitious regulation and legislation. We have seen the limitations and perhaps shortcomings of voluntary action. I think that the way to embed change in the long run is through setting those regulatory requirements, and certainly in the insurance sector, which is so vast and plays such an important role on both sides of the balance sheet, there is a need for that prudential action. Firstly, to protect insurers directly against the risks posed by climate change, but also, and crucially, to reduce the impact that insurers have through their activities underwriting and indeed directly investing in fossil fuel projects. So we're very pleased to be fully playing a leading role and really to be at the forefront of this discussion with institutions in the European Union and indeed further afield, including in the UK. And I would also just like to ask everybody to please do input to the consultation, the IOPA consultation. If you do require any assistance in navigating that, then my colleague Caroline is on hand. If you wanted to contact her, she's just shared her contact details there in the chat now. So please do contact us. And we will also be sharing a recording of this discussion with everybody following this. I'm absolutely delighted with the turnout, so thank you for everybody for staying with us. I'm conscious that we've overran, but we've had in the region of 100 people for most of this discussion. So it's yeah, I think for something that's often misunderstood and perhaps seen as rather technical, that's absolutely fantastic. So thank you very much, everybody. Thanks for joining us. Thank you to our speakers, and enjoy the rest of the afternoon.
Thanks, everyone.
Thanks to you. Bye-bye.
Goodbye.
Have a great end of the day. Bye-bye.